Most traders believe that losing in the market comes from bad strategies. They think they need a better indicator, a better entry signal, a more accurate system. But there is a silent problem that destroys more trading accounts than bad strategies. And many traders do not even realize it is happening. That problem is overtrading. Overtrading is not always obvious. It does not always feel like a mistake. Sometimes it feels like effort. Sometimes it feels like productivity. Sometimes it even feels like discipline. But in reality, overtrading slowly drains accounts, confidence, and emotional stability. In this video, I want to explain something very important. Why overtrading is the silent account killer. Because if you do not understand this behavior, it will quietly destroy your consistency. But if you understand it deeply, you can completely change the way you trade. If you stay with me until the end of this video, you will understand why overtrading happens, how it affects your psychology and performance, and how professional traders avoid this trap. And if you want to build a strong trading mindset and develop discipline in the market, consider subscribing to Bull Mindset. This channel is focused on trading psychology, emotional control, and the mental frameworks that help traders become consistent. Now let us begin with a simple question. What is overtrading? Overtrading is not just taking many trades. It is taking trades without a clear reason. It is trading based on emotion instead of strategy. It is entering the market too often, too quickly, or without proper setups. Overtrading can happen in different ways. Sometimes traders take too many trades in a single day. Sometimes they re-enter trades immediately after exiting. Sometimes they trade out of boredom. Sometimes they trade to recover losses. And sometimes they trade simply because the market is moving. Now let us understand why overtrading happens. The first reason is emotional pressure. When traders sit in front of charts for long periods, they feel the need to act. The brain begins thinking, I should be doing something. Watching the market without trading feels uncomfortable. This discomfort pushes traders to enter trades even when there is no clear opportunity. The second reason is fear of missing out. When the market moves quickly, traders feel they are missing opportunities. They see price moving without them. They imagine potential profits they could have made. This creates urgency, and urgency leads to impulsive trades. The third reason is revenge trading. After a losing trade, traders feel the need to recover the loss immediately. They want to prove they are right. They want to remove the emotional discomfort of losing. So they take another trade quickly, often without proper analysis. This cycle leads to more losses. Now let us talk about another important reason. Dopamine. Trading can create excitement. Every trade has uncertainty. Every trade has the possibility of profit. This uncertainty triggers a reward system in the brain. Traders begin associating trading with excitement. Over time, they start trading not for strategy, but for stimulation. This is where overtrading becomes dangerous, because the trader is no longer following a system. They are following a feeling. Now let us talk about how overtrading affects performance. First, it increases transaction costs. More trades mean more spread, more commission, more slippage. These small costs accumulate over time. Second, it reduces trade quality. When traders take too many trades, they stop waiting for high-quality setups. They begin entering average or poor setups. This reduces overall profitability. Third, it increases emotional stress. Each trade creates emotional pressure. More trades mean more emotional fluctuations. This leads to fatigue. And when traders are mentally tired, decision-making becomes weaker. Now let us move into real trading examples. Imagine a trader starting the day with a clear plan. They identify one or two good setups. They execute one trade. The trade ends with a small loss. Now the trader feels uncomfortable. Instead of waiting for the next valid setup, they immediately take another trade. This trade is not part of the plan. It is driven by emotion. This second trade also fails. Now frustration increases. The trader takes another trade, and another. By the end of the day, the account shows multiple losses, not because the strategy failed, but because discipline failed. Now imagine another trader in the same situation. They take one trade. The trade results in a loss. They accept the loss calmly. They review their plan. If no new setup appears, they stop trading for the day. This trader protects capital. They protect their mindset. The difference between these two traders is not knowledge. It is discipline. Now let us look at another scenario. A trader opens the platform during a highly volatile market. Prices are moving quickly. The trader feels excitement. They begin taking multiple trades. Some trades win. Some trades lose. But overall, the trader becomes exhausted. At the end of the session, they realize they made many decisions without clarity. This is overtrading driven by stimulation. Professional traders behave differently. When volatility increases, they often reduce trading activity. They wait for the best opportunities. They protect their focus. Now let us talk about mental frameworks that help prevent overtrading. The first framework is clarity of rules. Professional traders define clear conditions for entering a trade. If those conditions are not met, they do not trade. This removes emotional decisions. The second framework is acceptance of inactivity. Not trading is also a decision. Sometimes the best action is no action. Professional traders are comfortable waiting. They do not feel pressure to be active all the time. The third framework is daily limits. Many professional traders set limits on the number of trades they take per day. This prevents excessive activity. It forces discipline. Now let us talk about practical exercises that help control overtrading. One powerful exercise is the trade filter question. Before entering any trade, ask yourself one question. Is this trade part of my plan? If the answer is no, do not take the trade. Another helpful exercise is time-based restriction. Set specific trading hours. Outside those hours, do not trade. This reduces impulsive decisions. Another useful habit is journaling. At the end of each session, review your trades. Identify which trades followed your plan and which did not. This awareness helps reduce overtrading over time. If this video is helping you understand the impact of overtrading, consider subscribing to Bull Mindset. Because building discipline is one of the most important steps toward trading success. Now let us talk about something very important. Control. You cannot control the market. You cannot control price movement. You cannot control volatility. But you can control your actions. You can control how many trades you take. You can control your discipline. You can control your mindset. This control is what separates professional traders from emotional traders. Let me leave you with a final thought. Overtrading does not destroy accounts quickly. It destroys them slowly. One unnecessary trade at a time. One emotional decision at a time. One impulsive entry at a time. But discipline works the same way. One correct decision at a time. One avoided trade at a time. One calm moment at a time. The strongest traders are not the most active traders. They are the most selective traders. They wait, they observe, and they act only when the opportunity is clear. Stay patient. Stay disciplined. And remember that trading less can often lead to earning more. And if you want to continue building that mindset, subscribe to Bull Mindset. I will see you in the next video. Thanks for watching.